The IMF clearly sending out warning signals on the health of the European banks. The IMF says European banks face as much as a $410 billion hit from debt-stricken countries. That's according to a report released by the IMF earlier today. Now, the estimate comes as the IMF has said that risks to global financial stability have increased for the first time since the collapse of the Lehman Brothers in 2008. Now, the IMF has also said the estimate of spillover of credit risk on the banks does not measure the bank's capital needs, which would require a full assessment of the bank's balance sheets as well as income positions. Here's a word then from the IMF's chief economist.
Worries about sovereigns have translated into worries about the banks holding these sovereign bonds, mainly in Europe. And these worries have led to a partial freeze of financial relations, with banks keeping high levels of liquidity and tightening lending. Fear of the unknown is very high. Stock prices have fallen. These will adversely affect spending and growth in the months to come.
Well, the IMF also added that financial markets are worried that Eurozone will not be able to tackle the crisis and destabilize the region. He also added that the crisis may also spread to Japan and the United States.
What has happened is that markets have become more skeptical about the ability of policymakers, of governments, to stabilize their public debt. Worries have spread from countries at the periphery of Europe to countries in the core of Europe, and then to others, Japan, even the United States.